You've been on the pod the last year, at least twice, and I've asked you the same question. Where's the recession? It hasn't come yet.
Right.
What's going on? Did they achieve the soft landing? If they achieve the soft landing, doesn't that mean that the central bankers got their way? What's going on there? Where's this recession?
So there's two ways to think about it, right? So there's one is that that narrative is correct and that we are going to have a soft landing. Could that happen? Sure. The last time that happened significantly was 2000 to 2003 or so. After everybody remembers that as the dot-com crash, but we did have a mild recession during that period as well, and stocks did not do well over that period. And Nasdaq stocks got decimated; they went down like 80 some %. What happened then? It's similar to what we're seeing so far today. We're actually in indisputable manufacturing recession right now. Manufacturing has been contracting both in the US and around the world for several months now. It's absolutely in a recession. People are losing manufacturing jobs. New orders continue to kind of dry up. It's pretty ugly out there if you're in the manufacturing industry. But America is not a manufacturing economy anymore. Tomer actually touched on this earlier. It had to do with why we had a prosperous middle class before. What did we do? We exported our manufacturing offshore. We gave most of it to Asia, lots of it to China. So America is a service-based economy now. Services are not yet in a contraction, and they may not be. So when we get these what we call soft landing recessions, what usually happens is similar to what we're seeing today is unemployment doesn't budge too much. Manufacturing goes into contraction mode, but the services sector remains in a somewhat mild expansionary mode, which is what they are right now. If it's possible that manufacturing will bottom in the next couple of months and then turn higher and get back to expansionary mode, we may actually avoid a significant recession. That's actually possible. But when you look at things like the credit standards are tightening, lending is kind of drying up significantly with banks. We still have these regional bank issues out there. We still have these rates that are suffocating businesses. We still have lots of junk rated companies with junk rated debt that are not going to be able to roll over their debt. They've been paying really low interest rates on, even though they have a crappy business. Those interest rates are jacked up like 6% or more higher. And to Tomer's point, they're paying many multiples of dollars more than they used to have to pay. They are going to go under. We're seeing lots of defaults already start to happen. The longer rates stay high, the less chance these companies, I call them zombie companies because they can't afford to pay their debt, the less chance they have at surviving. If that happens and it rolls over quickly, that could throw us into a deeper recession. So that's the other path. So path one is we actually do get this soft recession and it turns out, hey, I guess those guys were right. The other path is services get sucked down into contractionary mode or recessionary mode like manufacturing is. We see this huge spillover into these junky companies and they go up, they go belly up, they default on their debt. And we have a serious recession. And you look at the yield curve still being inverted. What that tells me is we're still not at the point where the recession is ready to start yet. Look at the yield curve inversion. Look at unemployment. It still remains low. It's undeniable. It just continues to remain very low. If we do head into a deep recession, that will spike and it will spike quickly. And then the other thing to look at as far as a recessionary indicator is the high yield OAS, options adjusted spreads. That's the difference in the yields between this high yield or junk debt, what that yields, which is typically much higher than what underlying treasuries yield. When you're in a complacent economy and the stock market's doing well, like we are right now, and volatility is low, that spread shrinks over time. But when you head into recession and people start to panic and those companies start to go bankrupt, you'll see that yield blow out. So right now we're in this kind of like Goldilocks happy place with that indicator. If and when we do head into a recessionary bear market, we'll see that spread blow out, and that'll be the time to get nervous, to get worried. So to answer your question, where is it? It's not here yet, and I don't think it's coming anytime soon based on the indicators I look at. If it does, you can have me back on your show and I'll let you know that I'm starting to get nervous again, but I'm not nervous right now.
Gotcha. And then my question to you, Tomer, is if they pull off this soft landing, doesn't that kind of defeat a lot of the narratives that Bitcoiners were saying about central bankers?
It's interesting. I try to focus on real life rather than all the financial instruments and derivatives and where things stand. And as far as I'm concerned, in my own personal life and in the lives of the people around me, we've been in a recession slash depression since March of 2020, since COVID hit and we started to lock down and we found ourselves hoarding toilet paper and we couldn't find toilet paper and we were not going out to the movies anymore and not going to plays and not going to sporting events and not going to restaurants and not going to theaters. And our quality of life in terms of what we're actually doing and spending and enjoying has took a step back, and for very few people who I know does it seem to have returned to pre 2020 levels. And so, like for me, there people are watching what they buy. They're pinching their pennies. They are concerned. They're carrying anxiety around because the future seems uncertain. Many people still carry over concerns about healthcare. What we do spend our money on has become skewed not to things that increase our actual quality of life, but increase our concerns. There's more money spent on anxiety medication, vaccines, all these sorts of things. I can't be too concrete about everything because everyone's experience is different, but I just see that there's less stakes in the supermarket because the price is higher and people are buying less of it. That to me is a recession, right? I used to be able to afford steak regularly. Now I buy ground beef when I can, and I buy ramen noodles if I'm in a different situation. So I think we've suffered a setback. Some of it, to again be fair to the central bankers, is the world got caught in a panic, maybe rightly, maybe wrongly, about how dangerous COVID was, and we went into this lockdown mode, and a lot of the economy shut down. Like people stopped going to the uh, slaughterhouses, so no wonder meat dried up. People stopped going to factories. People stopped doing all sorts of things. It's kind of easy to restart a service economy, but if the services are you're going to see a therapist because you've got psychological conditions, that measures as a growth in GDP. It does not measure in a growth in our quality of life. If you didn't need a therapist before, that was a better situation. So I find this a very cloudy picture. It's one thing to just measure things as a number as GDP, but it's quite another to say, like, what's my quality of life? What's my quality of happiness? Am I happier? And that's why I think recession is kind of this word, right? The real word is the word that people used to use was depression. Am I finding myself depressed? Is my mood, my quality of life destroyed, or am I in a joyful period? And I just don't see anywhere near as much joy as we used to see years ago, and we're at the risk of forgetting how joyful we once were and how anxious and anxiety ridden we now are. So I don't mean to paint it as a negative picture, but zooming out, I'm just not seeing the kind of happiness and joy that we experienced before all this got going, and so I'm less focused on these small percentage points of numbers and yield curves and options and stuff, and just saying, I want to be happier. I want to see the people around me happier and doing the kinds of things that make them happy and not so distressed. But I don't know, maybe I'm gloomy and turning people off, but it just seems to me that is a
I
real
I
problem.
I love the way that you define that, and I actually want to push it back to Dr. Ross. Under that definition, under that outlook, right? Because it's a lot more personable. Would you say we're in Tomer's definition, or the way that Tomer described a recession or depression?
Yeah, 100%. In fact, to piggyback and accentuate what Tomer said, we went over 2 years, which I think was the longest streak ever for the United States, with decreasing real income, meaning that even though Americans had some income growth, inflation grew faster for over 2 straight years, meaning quality of life for everybody went down, meaning everybody's working hard but they can afford less and less. So the steak Tomer was talking about, now they're buying hamburger, right? And that's happening all across America. And so you see that, money isn't happiness, but man, when you have money problems, you struggle, and it's hard to be happy, right? And that's the number one issue in marriages. So bad marriages, the number one thing that people struggle with is money issues. So totally agree with that. And in fact, I think that's going to be, unfortunately, the theme of this decade. I think we're going to have what we call stagflation. Again, that's just another fancy term. All that means is a stagnant economy, so not much growth happening, but higher than we're used to, and more volatile inflation. The last time we had that significantly was back in the 1970s, even though we have a lot more debt now, so it's actually worse now. But the
I'm
last
old
time
enough to remember it. I
what's
lived
that?
it. I'm old enough to remember it.
Right. Yeah, I was born in the 70s. I think I was born in the worst year of that. Um, but so case in point, though, that was remembered as a tough decade for America, and a tough decade around the world, mostly the Western world. Actually, emerging markets did okay. There are different, so as an investor, there are different ways to think about things that do well. Things like hard assets, things like gold, property did well, commodities in general did well, emerging markets did well as investments. And I think, obviously they didn't have Bitcoin around that time. Now we do. To me, that's very encouraging for people who are in the Bitcoin space. If you're just hunkering down and working hard and staying humble, as Odell would say, and stacking sats, I think you're going to do pretty well. And you may notice that your quality of life and your depression levels should improve relative to the rest of America. I'm actually worried for America as a whole for this decade. I think it's going to be a really rough and tumultuous decade in general for America, and we're already living through it. It started in 2020, and it's just continuing on.